In the case of these, watching Silicon Valley Bank's customers waiting outside the bank, these are high-tech investors, and they're waiting in lines to go get their money physically. What does that tell you? Maybe they put some of it under the mattress, when they came out. So deposits are leaving the system, interest rates up 20-fold in 1 year. This is a major, major shock. And it doesn't seem to me that the Fed is acknowledging that the banking system is under duress here.
Hey guys, welcome back to Library of Wealth. ARK Invest CEO Cathie Wood gives us her market outlook for the next few months and discusses the lack of trust currently in many financial institutions since the collapse of Silicon Valley Bank. Wood believes that investors may now be resorting to keeping their money outside of the system and warns that we've never seen market volatility like this before. She notes that interest rates have increased significantly in 1 year, which is a major shock to the system. However, Wood believes that the Federal Reserve is not acknowledging the stress on the banking system. She says the Fed's plan to raise interest rates too rapidly is already a huge mistake, as it will risk tipping the economy into an unnecessary and deep recession. Let's get right into the latest interview with Cathie Wood as she gives her market prediction for the coming months and what we can expect heading into the first half of the year. If you enjoy the content we do here, don't forget to hit the like button and subscribe to the channel. Let's get right into the video.
I began getting concerned about how rapidly the Fed was raising interest rates because I saw credit default swaps, so insurance policies against bankruptcy. I saw credit default swaps moving up for banks broadly last spring.
Yes.
And this is as they started, as I think the markets began to understand, this Fed was going to start raising rates at a very rapid clip. And then the yield curve inverted in July of last year. And that was another signal that not all was right out there. The bond market was signaling something. And I know you didn't agree that I should have written an open letter to the Fed in October. But the reason I did that is I feel as though there's no debate taking place. Maybe there is, and they all decide unanimously. Right. And all I was saying is, look, credit default swaps are going up. This is insurance policies against bankruptcies in the banking system. You've got an inverted yield curve. You've got commodity prices coming down. You have the gold price actually peaked in August of 2020, and it is in a range. And then, of course, it broke that range. So I was just raising the question about how can you be unanimous when there actually is some conflicting data out there that you should be sharing your analysis with us? Like, how are you responding to this? So that was more the spirit of the letter. And then I basically said, okay, we've said our piece. And now around this banking crisis, I think all of those variables, the credit default swaps, inverted yield curve, were pointing to two mistaken assumptions in the banking system. One was that during COVID, when we were worried about a depression, that a lot of banks that were being flooded with stimulus payments were taking that money and investing in safe securities, their government-backed mortgage securities, treasuries and everything, but they invested long-term, put in the held to maturity category. And in the case of Silicon Bank, they were earning really 1.6% on that book. So what was the assumption they made? They made the assumption that, gosh, we're probably going to be fighting a depression here. And surely interest rates are not going up anytime soon.
Correct. So
that was the first mistake. And then the second, and it was a pretty good assumption because we've never had now it's a 20-fold increase in interest rates in less than a year.
Wood argues that signals such as credit default swaps and an inverted yield curve are indicators of trouble in the banking system. She's identified two mistaken assumptions made by banks during the last 3 years, namely that they would be fighting a depression and that interest rates would not go up, which led them to invest in long-term securities. However, interest rates have increased 20-fold in less than a year, which has sent a massive shock through the system.
If you go back to Volcker, it was a twofold increase, 10 to 20%, that shocked the system. And what I like to say is the system is being shocked more so than in the early 80s, because we had 2 weeks ago an inversion in the yield curve of more than 100 basis points. So more than 100 basis points on 4% is a lot different than more than 100 basis points on a 15% interest rate. So I've likened it to the Richter scale. So back then, if you look at 4% over 15, that's 6.5 on a Richter scale in terms of earthquake. If you look at 1% on 4% or 100 basis points on 4%, that's a 25 on the Richter scale, which is 4 times. Now into quantitative tightening. So they're actually selling. And yet the Treasury bond yield has gone down since last October. It peaked at 4.3%. Now we're at 3.6%. And I've always thought, bondholders have to be the most focused on inflation. Long duration. Right. We should as well. And we manage long duration assets. And the last 21 and 22, as fears of inflation and interest rates were rising, were just for long duration assets. Last year was the worst year for the bond market since the 1780s. So we have never had a bear market in bonds like that. Now that is turning around, and we've seen the long-term treasury go from 4.3 last October to 3.6 roughly. And the way I look at it, a bond investor is trying to protect himself or herself from inflation. They're trying to protect. And so that market, I believe the TIPS implied inflation rate is about 2.1 or 2.2?
Yeah, something like that. It's very close to that.
Yeah, it's very close to that. And it hasn't deviated very much from that. I think it got to, 2.5 or 6, something like that?
All of the variation has been in the expected real yield, all of it, which is exactly what you're saying.
According to Wood, the Federal Reserve's quantitative tightening, where it is selling assets, has resulted in a decrease in the Treasury bond yield from 4.3% to 3.6% since October. She highlights that bondholders are the most focused on inflation, and managing long-duration assets is challenging when there is a fear of inflation and rising interest rates. On the other hand, she suggests that despite the Fed increasing the supply of bonds in the open market, the expected real yield has actually gone down. Wood believes that this is due to a flight to quality, where people are worried about the security of their assets and deposits in banks, leading to panic buying of government securities, pushing the price of bonds up and the yield curve down. As the government and financial systems continue to navigate these challenges, it remains to be seen how the Federal Reserve will respond to these concerns. What do you think about Cathie Wood's latest interview? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.